Hi, and welcome to the course, MBA SAP Fundamentals of Corporate Finance. First thing I'd like to do is, this is the introduction section, so I'd like to talk to you about what you find in this section. There's 3 videos in this section, and there's also, in the first one, is a link to a download of my book that comes with this course. And check that out. Check out the next one is basically about why corporate finance is important. And there's also an infographic there. And take a look at that infographic. That is a good reference guide for the first section of the course. And so now what I'd like to do really is talk to you about the entire course and roadmap it out for you so you get an idea of where we're going to go. So in this first section, there's the introduction, which is this section, which has 3 videos. And then we're going to move through a very important part. The course is basically in 4 sections, right? So the first section is financial statements. And that is key to finance, obviously, is financial statements are the end product of accounting. And it's a balance sheet, an income statement, and a cash flow statement. And those 3 statements are interconnected in ways, and you really need to understand how to read those financial statements and understand them, and how they're interconnected, and how the numbers, the money, flows through those different statements. So that's the first part that we're going to go over. That section is the next section. It has a ton of videos, and I'll put a summary, an introduction on the front of that too, that you'll see. Then we go into financial statement analysis. And really there, it's ratio analysis. And there's 2 types of ratio analysis. Longitudinal ratio analysis over time. Is something getting better or worse? It's all about performance. And the other way is vertical analysis, where you're comparing one company to another and to see how companies rate against each other. Now, the thing you want to do with financial statement analysis is it's performed with ratios, right? It's because you want to normalize for looking at a small company relative to a big company, or the same company over time. How is it performing relative to those other numbers? So we go through that financial statement analysis. Once we get an idea about financial statements and how to analyze those statements, which is also good if you're thinking about investing at all in the stock market. You want to be able to look at the financial statements from whatever company you're going to potentially invest in, and be able to say, how's it doing relative to the rest of the companies in their sector or other sectors, right? So this stuff's really important. Then we get into, and this part here, the second part, is cumulative. So you really want to also follow this and this section in order, because each one relies on the next section, right? So they build upon each other. The first thing we're going to do is the time value of money, right? Time is money, and that's true. $1 today is worth more than $1 5 years from now, right? Because of what? Interest. If you put that dollar in the bank and you were getting 10% interest, it would be worth $1.10 the next year, $1.21 the next year, and on and on. So there's the time value of money. And so when you take money in the future and pull it back to present value, we have to figure out how to do that. That's called discounted cash flows. That's the next part. And then from discounted cash flows, you want to see, is that cash stream from an income producing asset, whether it's rents or whether it's income from a company or whatever, is that stream of cash flows pulled back to the present worth more than I have to pay to buy that income producing asset? And that is net present value. You're taking what the cost is against the discounted cash flows of the present value. And then we also talk about, after that, internal rate of return. What is the rate of return of an investment over time? So these things are all in order. Then after that, so that's the first half of the course. After that, the second half of the course is not necessarily, it's sequenced, and I put the sequence together, but if you find something that's of interest to you in that second half, you can go there first after you've done this kind of stuff and really understand it. So after that, we go in and we talk about financial projections, how to do the financial projections that the DCF would be, discounted cash flows would be based on. Break-even analysis. When do you break even? When do your costs, your fixed and variable costs, get covered by your revenues? How far out is that? And analyzing, is it a good project or or a good business to be in. And then budgets. Obviously, we have to have budgets, right? We want to budget how much we're going to think we're going to make in revenues and how much we're going to put out in expenses. And then we take those budgets and we compare them against the actuals and see, are we actually measuring up with our predictions, our budgets and predictions in line with the actuals each month. And that's from accounting, you get the actuals, right? And then we go through some more contextual and general topics to fit finance into the overall scheme of the world and of business, right? So we talk about technology. I'll talk about technology and where that fits in with, with accounting and finance. What type of, like spreadsheets, what a Excel, what a boon to accounting and finance those were. Can you imagine if we still had to do those things by hand in a book or something like that, in a ledger book, and then add them up and all the addition mistakes and everything else that could happen? So there's tons of technology that has come up and make Quicken, for accounting. All kinds of great financial tools. And in like Excel, there's a formula for NPV, a formula for IRR. In the past, we couldn't even do internal rate of return because that is an iterative formula. There's no formula for it. You guess and you overshoot and undershoot until you target it. So a computer can do that very quickly, and it's made IRR a function that you can actually use now. So we'll talk about the technology. We'll talk about economics and finance. Those two, are overlap quite a bit, but what's the difference between economics and finance, and where do they overlap and where are they different, right? I'll talk about that. And then stock portfolios and the capital asset pricing model. That's a big part of finance, right? You want to be able to do diversification and figure out a stock market portfolio. My book is also available as a download with this section, so that's a really great section too, because it's key to think about investing in the stock market so that you can make money, so that you can become economically independent, and so you can make your choices in life. So this is a key part of it. And then business ethics I finish up with, basically. That's very important too, because when you are working in accounting and finance, there's lots of pressure to maybe cook the numbers a little bit, right? And to sort of have really strong ethics is absolutely critical. So I want to focus on that. And then there's a conclusion section. And what I suggest is scroll through and see all the different sections and the lecture topics, in each one, the titles. And then you'll get a feel for what I just talked about here. But basically, this is the outline. This is the course. Now let's get to work.